All right. Good afternoon, everyone. I wanted to thank everybody for participating today. As you all know, for those of you who have participated in the past, we send out a recording of this so you can use it for your own purposes and everything. So that'll be coming in probably, in a few days after we edited it for brevity and everything, take out some of my superfluous interactions. So the whole point of this one today is pretty simple. It's to give you a basic understanding of how the unemployment system works. I have been asked over the years, including after some of the webinars, exactly how does the unemployment system work? How is it do I get charged for a certain type of employer? Why do I get a claim on an employee who has not worked for me for 9, 12 months? So on and so forth. So this is just really kind of to give you all a very basic understanding of how this system works and how it impacts each of your organizations. So without further ado, the obvious first step is what is unemployment insurance? And it's probably not really appropriately named because it's not really an insurance in the manner that we understand to be, but it's meant to be a means for an individual to bridge the gap between terms of employment. So at the height of the Great Depression, individuals were being laid off at record numbers, and there was no safety net for those individuals to make ends meet. They were completely without any means of income because there was no system in place for them to have that safety net. And it was set up as not an entitlement program. It was set up as a means to give unemployment a benefit to people who were unemployed through no fault of their own. And that's, as you've been through these other webinars that we've done, you've heard a lot about deliberate and willful. It was meant to award people this benefit if you were laid off or if you were discharged for reasons that were that did not meet the statutory definition of misconduct. So it's not a guaranteed entitlement. Even if you're laid off, you may not qualify for unemployment benefits because there's other requirements that you have to meet in order to establish good standing in the claim. One of the more common requirements, of course, is work searches. You must, depending upon what state you're in, you have to meet a certain number of work search requirements in order to qualify for your weekly unemployment check. So even if you're laid off, it's not a guaranteed benefit. It is completely funded by employers through the collection of taxes or reimbursements. There's a misperception that employees pay into the unemployment system. They do not. Employees do not pay a single dime into the unemployment system. There are some states that have an employee contribution, but that goes more towards their state disability or state workers' compensation programs. It is not meant to be funded by, it does not fund the unemployment trust fund in any manner, shape, or form. The expense of each individual employer, what you pay in that particular line item of unemployment tax, is dependent upon your claim experience. So how well you do at preventing unemployment claims is going to determine whether or not what your unemployment tax rate would be if you're a merit-rated employer, or what you pay in reimbursing charges if you're a reimbursable employer. So how do I pay? Well, there's three basic forms or common forms of payment. Most employers fall into what's called the merit-rated system, and that is the for-profit employers where a vast majority of employers fall into, and you pay a quarterly payroll tax. And each employer is assigned a tax rate based on the ratio of their taxable payroll to the benefits that they are charged in the fiscal year, or their account balance at the end of that fiscal year. The states have different financing methods. The most common one is that you maintain an account balance, and that account balance is then compared to an average taxable payroll over a period of time. Some states it's 3 years, some it's 4. It doesn't really go any higher than 5, but that creates a ratio, and then that ratio is assigned to a tax table which determines your unemployment tax rate for that calendar year. You also merit-rated employers only pay taxes on what's called the taxable amount of wages. It's called the taxable wage base, and that varies from state to state as well. In Missouri, for example, the taxable wage base is $13,000. After the first $13,000 you pay that employee in that calendar year, you do not pay unemployment tax on that employee any longer. So once they meet that threshold, whatever state you're in and whatever threshold you have to meet, then that person falls off the tax rolls. You still have to report the wages, but you don't have to pay unemployment tax on them. Turnover is a big common factor in this because employers who have high turnover and are constantly hiring new employees, that wage base has to be restarted for every new employee that is hired during that calendar year. So if you hire an employee in the middle of the year and your wage base is $13,000, that wage base begins when that employee is hired. It resets at the beginning of every new year. All employees go back to 0, and then you collect you start the wage base over again, and then they fall off as soon as the wage base is met for that particular calendar year. Reimbursable employers, that is what is your nonprofit or not-for-profit organizations. Most city governments, most school districts, a lot of hospitals, county governments, nonprofit organizations, those fall into this particular category of employer. You have to be an IRS-approved 501c3 in order to be in this particular category. And what happens is that in this particular category, each employer pays the actual amount that a former employee collects in unemployment benefits. You don't pay the quarterly tax, you only reimburse the unemployment trust fund dollar for dollar whenever a former employee collects unemployment. The catch to this is there's a tax savings involved in this because the reimbursable employer, the nonprofit organization, doesn't have to pay the quarterly tax, but they lose the ability to protest base period only unemployment claims. And I'll explain what a base period unemployment claim here is in a minute, but they only can control their destiny on claims where they're the last employer. So there's a trade-off here, is that you don't pay the upfront quarterly payroll tax like the merit-rated employer does, but you also lose the ability to protest certain unemployment claims. As I said, most nonprofit or not-for-profit organizations use this particular method because of the tax incentive, the tax savings incentive that they have, because almost always the reimbursable charges are far less than what you would pay in annual unemployment tax if you were a merit-rated employer. And the third method is a rarer method. It's only used by a few states, and it's what's called governmental rated. For our Kansas school district friends who are on the call, I know there's a couple of you on the call at least, this is the system that you pay your unemployment tax on. It is a separate trust fund, and it is all employers who are governmental rated are lumped together, and they pay a smaller payroll tax based on the ratio of benefit charges to your total payroll. So you're not, the taxable wage base does not apply to the governmental rated employers, because the calculation of your unemployment rate from year to year is based on the previous year's benefit charges to what your total payroll is. And only governments or quasi-governmental agencies qualify in this particular area. That is county governments, you know, state governments, school districts, so on and so forth. How is the claim liability determined? Well, as I was previously mentioning, all employee wages are reported on a quarterly basis. That quarterly wage report that everybody submits, including governmental rated employers, you are reporting to the state the wages you paid to each employee in that particular quarter. Okay. During the and that's at the same time that you submit, if you're a merit-rated employer, you submit your actual tax liability at that point for the employees who have not met the wage base. When those new claims, when a person files a new claim, those claims are then cross-referenced by Social Security number to the quarterly wage reports that have already been submitted. So what this does is it establishes what's called the base period. And the base period is the period of time which determines which employers and what wages are used to calculate the liability for that particular unemployment claim. When they look at that, the liability is then set proportionally to the percentage of wages paid in the base period. So if there are 4 employers in the base period, they divvy up the liability of that person's unemployment claim based on the percentage of wages that each of them paid in the unemployment in the base period. Some states do differ from this, and I'll explain that here in a little bit more. That is what's called the last employer only system, and I'll explain that here in a little bit. But most states, a huge majority of the states, are the proportional method at which the liability is assigned based on the proportion of the wages paid in the base period. So how do you calculate and determine the base period? Well, the base period is a set of rotating calendar quarters, and wages paid in the current calendar quarter are not used because they have not been reported to the state as yet. There is a lag quarter which is put in place. And the lag quarter is always the most recently completed calendar quarter. So the wages in that lag quarter are not included in the calculation of liability. If you've been through our previous webinars, you'll recall maybe hearing that if the individual is let go within a certain time frame, certainly the first 90 days, that the unemployment cost to you, the last employer, is 0. That's because those wages are falling in the lag quarter and they're not used to calculate the liability. So what's used to calculate liability and to establish the base period is the previous 4 quarters to the lag quarter. So for talking purposes, if I were to file an unemployment claim today, we're obviously in the first quarter of 2017, those wages are not included. The lag quarter is the 4th quarter of 2016. They're not included. It would be the 4th quarter of 2015 and the first 3 quarters of 2016 is what's used to establish the base period and who is a liable employer. So going back to my introduction, when you get that unemployment claim on an employee who's been gone for nearly a year, it's because of where the base period is and where the wages are falling. That's why you might get an unemployment claim on an employee who left you in October of 2015. Now, they're only making a charge decision in this particular case which leads us to the next thing, is what types of claims are there? Well, there's 3 types of claims. There's what's called the last employer only. And those claims are generally a 0 liability to the last employer unless it occurs in what's called a last employer charging state. Okay, Georgia is a perfect example of that type of system. Is that if they go down through each employer in the base period, and if that employee has met the next employer, they've earned enough wages or served enough time for the subsequent employment, that employment falls off, and it keeps rolling downhill until it gets to the last employer. It's usually a time frame. It's either 30 days or it's a certain amount of wages. if they've earned that amount of time, worked that amount of time, or earned that amount of wages for that last employer in Georgia, then the liability rolls to the last employer, and they are charged only for the amount of wages that they earned up to the maximum. But most employers fall under this last employer only thing, where there is a zero liability unemployment claim if they are not the only wages in the base period.
Okay.
The second type of claim is probably one of the second most common one, is base period only. These are the claims that I described that occur where the employee left you back in October of 2015, but you still have wages reported in the base period. The only determination the state is making at that point is whether or not you're going to be charged for your proportion of the unemployment claim, okay, your pro rata share. So those are the easiest claims to avoid, generally speaking. These are the claims, though, that the reimbursable employer loses the ability to protest because they've agreed to reimburse the unemployment trust fund. In lieu of paying that quarterly payroll tax and taking the tax holiday, taking the tax advantage of avoiding the merit-rated tax, they lose the ability to contest these unemployment claims. Okay. Then the far most common is last and base. It's where you are not only the last employer, but you also have a lion's share of the charges. The charges are still proportional. They still are going to be divvied up, but generally speaking, the last employer in these scenarios has the lion's share of the liability. They're also determining whether or not the claimant is going to collect unemployment benefits at all. Remember, the last employer always determines claim eligibility, no matter what. So it comes down to a question of, am I chargeable or am I not, and what proportion am I going to be chargeable, and that has to do with how many wages are assigned in the base period. So here's the different charging methods real quick. In a majority of the states, as I mentioned, employers are charged on a proportional basis. That is, if you have 15% of the wages in the base period, you're assigned 15% of whatever liability is assigned to that particular unemployment claim, and so on. The other kind, as I explained a little bit, is in some states, the liability rolls to the last employer. So as I tried to explain in Georgia, once you work a certain period of time, I believe it's 30 days, then you become the only chargeable employer. But say you only work that employee for 30 days and they only earn $500. You can't be charged for anything more than what you paid the employee. So your maximum liability is $500, and the remainder of the liability assigned to that particular claim, because it's going to be far more than $500, comes out of the general trust fund of the state. That's why in some states, that apply this portion of this method of charging, you see surcharges attached to the unemployment tax rate, because they are accounting for the liability that cannot be assigned to an individual employer. They're distributing that liability, the remainder of that claim, out evenly to all employers throughout the state. So it's kind of it's a unique system, and only like 15% of the the states use this type of method. The type of employer that you are, reimbursable, governmental rated, or merit rated, does not impact the charging method. You're all charged in the same manner, so that doesn't have any bearing on whether or not you're a different type of employer. It's all based on the same type of system. How is the claim liability determined? This is one of the more common questions that we have. The amount that a claimant receives is a statutory amount. The state legislatures go in and they determine what the maximum weekly benefit amount is. In Missouri, for example, the maximum weekly benefit amount is $320 per week, for depending on the number of weeks, for 20 weeks maximum. In Kansas, it's $479 per week between 16 and 26 weeks. It varies depending upon a variety of factors, but the maximum is statutorily defined. Some states are indexed to the average wage of every employee in the state. So there's actually some states where the maximum benefit amount will increase year in and year out if the wages in the state on average keep increasing. So they're indexed based on that, or they're statutorily defined. The best way to determine what the liability of an unemployment claim is that you take the wages that you would have paid in the base period, and you know how to calculate the base period at this point by figuring up the wages in the calendar quarters that would be impacted, and it's roughly 1/3 of the wages paid in the base period will constitute an unemployment claim. They are capped depending upon the state, as I mentioned, based on the number of weeks that the state pays and the amount that the state will pay out per week. Again, in Missouri, using them for simplicity purposes, the maximum you can collect is $6,400 if you can collect all 20 weeks. This doesn't matter whether or not you're the CEO of the company who's been fired or if you're a custodian for the company. You can only collect the statutory maximum. The claimant has a defined number of weeks, and they have a 12-month period in which to collect whatever amount is coming to them. So if you filed an unemployment claim today, your unemployment benefit year would revert to the previous Sunday. So from February 19th of 2017 to February 18th of 2018, you have that 12-month period to collect whatever is coming to you if you're eligible. So that's pretty much that's our kind of the keep it simple today, and we'll probably have another session on some basics here in the upcoming months. And with that, I will take any questions if you wanted to type them. Marlene, we will be sending the PowerPoint out to everybody. You get it along with the video, and it can also be found on our website as well. So are there any other questions pertaining to the presentation?
Not for me, no.
Well, if you ever have any additional questions that you think of afterwards, by all means, don't hesitate to email me, and my email address is right there, or call us. We will always be happy to answer any questions you have, and we appreciate your time. And if there's no questions, then appreciate your time, and I hope everybody has a great day.